Welcome to the Smarter Money Life podcast powered by Forum Credit Union, your go-to podcast for all things personal finance, where we break down complex financial concepts into simple, actionable steps. Whether you're looking to save more, invest wisely, or plan for your future, we've got you covered. Join us each episode as we bring you expert insights, real-life stories, and practical tips to help you live a smarter money life. Hello, everyone. Welcome back to another episode of the Smarter Money Life podcast. I'm your host, Andy Mattingly. And today we're diving into a topic that, it's kind of important, being a first-time prospective homeowner. And, being a homeowner can sound very exciting, but you also have to make sure that it's the right time for you to be a homeowner. So instead of just relying on me saying, I've brought in a very important person. It's Chelsea Coleman. She's one of our mortgage loan originators, or in the industry, they're called MLOs or LOs, because this really is a significant journey, and she has a lot of great stories to tell you about how to help and how she's helped people. So Chelsea, thank you so much for joining us today.
Well, thank you for having me, Andy. I'm excited to be here and share some knowledge, give some information, and help that first-time home buyer.
Okay, good. Well, I want to kind of walk people into just like first deciding whether they want to be a homeowner. I think it's always important that they understand what are some of the day-to-day changes you experience from becoming a renter to actually owning the home.
Well, and it can be big. It can be a difference from the monthly payment and just a difference from when you're renting. You can call the leasing office if something breaks, like someone's there, they can fix it. But when you own a home, like it's all on you. So if the furnace goes out, you have to call, get that fixed, and it can be additional funds, money, and costs. So yeah, that's kind of the biggest thing is being ready for when something goes out, like you have to call and get that fixed.
Yeah, the worst thing is in the morning you're getting ready for work and you have no hot water and you go down and you find out the hot water heater is leaking and you're like, oh, right?
Yes, and then you call it around and you get the quotes. Then you're calling us for a home equity.
Exactly. So that's some of the changes that someone might experience. But so let's talk about how can you determine what you can afford in a home? Like, can you walk us through, there's, of course, the mortgage payment, but there's a lot more that goes into it, correct?
Right. And that mortgage payment, a lot of people, when they call in and I'm going over what the numbers look like when you have purchase price, you have your down payment, what that loan amount is. And that monthly payment, you have principal, interest, taxes, and insurance that's included in the monthly payment. But also you might have a HOA that's monthly that you have to pay. A lot of condos come with HOA. So that's something else you have to add in. And then you have your utilities that we don't look at as a lender when it comes to qualifying you if you can afford this monthly payment.
Right. That makes sense. And what's that term that they call it that where they put your, your insurance and your property taxes? What's that term?
Oh, escrow.
Yes.
Your escrow.
Thank you. Because, people hear about escrow sometimes and they're like, well, what is that? Well, that is part of your monthly payment and you have to put that in there. And, I want to stay on this because you said something about how much you can afford on your own home. And you brought up about higher utility costs. And there are a couple of things that factor into that. One is, the size of home, but then also the age of home.
Exactly. And so that's something like you just have to keep in mind because, again, you have that principal, interest, taxes, insurance. And depending on the age of the home, how old the roof is, that homeowner's insurance quote could come in a lot higher than what I estimated on that pre-approval when I initially went over the numbers. And so that's why I try to coach my borrowers. I'm like, this is an estimated payment. Once you actually find the house, the property taxes are going to be specific just for that property. And then the homeowner's insurance, you have to call in, get a quote, they'll bundle together your car, whatnot. So that could vary and it could change that monthly payment. So you got to keep that in mind. And then again, like you said, utilities, how big the house is, how much, heating, cooling.
Right.
Yeah.
A lot of people know about down payment, and we're going to come back to that. But what are other funds you might need at closing besides the down payment?
Right. So you also have closing costs. And so that consists of your loan costs, prepays, and escrow setup. On a purchase, you have to pay a full 12 months of homeowner's insurance at closing. That's included in the prepays. And then again, back to escrow, they're going to set you up an escrow account, hold 2 months for property taxes, 2 months for homeowner's insurance. So you're going to be looking at some additional costs for that cash to close on top of the down payment. And then after, last July, that change that happened in the real estate industry, you might have to bring additional funds for the commission for your realtor.
Yes.
And so that's something else that's changed where it's like, okay, maybe they signed that buyer broker compensation agreement for 3%, and the seller agreed to pay 2.5. Well, there's still an additional 0.5 that has to be paid, and that might be on the borrower, on the buyer to bring that to closing.
And that's a good point, because that's something new. A lot of people buying homes now, their parents are giving them advice, and they're always like, "Oh, well, there's going to be, that's going to come out of the seller's part," and that's not the way it is anymore. Both people have to negotiate, and that's something that I think is important. Is on another podcast, I'll probably have you come in and we'll talk about how to work with realtors and things like that. But that is a very important thing about having those closing costs. Now, this is something that sometimes you hear about points. Can you explain why people might want to pay points or not?
Yeah. When you hear points and discount points, basically you can buy down the rate, get into a lower rate to try to lower that principal interest in that monthly payment. And so I always disclose the best rate without paying any points initially. And then once, if that monthly payment isn't fitting into that borrower's comfort zone and where they want to be, then I might say, okay, we might be able to buy down the rate and get you into a little bit of a lower rate and lower that principal interest. So you have that option. I see it more when the borrower is receiving a seller credit and that's some additional funds. So they might use that to buy down the rate.
Okay. So that's good to know. Now, you mentioned down payment. And so the biggest question and the biggest, I think, myth out there is, do you really need 20% down to buy a home?
No, not at all. So the minimum down payment for a first-time home buyer is 3%. And then if you're not a first-time home buyer, it's 5%. You're considered a first-time home buyer after 3 years has gone past where you haven't had a sale or a purchase. So the 20% is more so to avoid PMI. And so if you have that, that's an additional cost to keep your monthly payment lower. And I've been seeing a lot of first-time home buyers bringing the 20% and maybe getting a gift from mom or dad, or they have their money saved, and they can do that to keep that monthly payment in a more comfortable. Because again, a lot of people don't know that the property taxes and the homeowner's insurance is included in that monthly payment.
Right. That makes sense. And you talked about gift, and that used to be something that people couldn't do as much, and you can now. You can get the full 20% down as a gift, correct? Mm-hmm. Are there any other things with the down payment? There are certain programs. You've talked about lower ones, but there's also some programs. I know they're very limited, and the funds run out all the time. But almost every year, there's programs where certain people can get that money given to them. It doesn't have to be from a relative. It can be from some of the companies that we work with, correct?
Yes. And recently, the Launch program through Federal Home Loan Bank, that one went through where it was up to $20,000, and you can use that for down payment assistance and closing costs. But I actually had a particular member that used it for more buying power. So he had his down payment and closing costs already, but he used that to be able to purchase a house a lot more than what he qualified for. Mm-hmm.
Okay.
So it's nice.
That's good to know. Now, here's a thing that I think really gets people messed up, because they're buying it with someone else, either their spouse or their significant other. Credit scores. So how important are credit scores? And it's not just one person's credit score if you're buying together, correct?
Correct. So the credit score is very important, and it's different on the mortgage side than versus if you're going to get an auto loan. So mortgage is a tri-merge credit pool. So we pull all three credit bureaus. That's Experian, Equifax, and TransUnion. And when it's a joint application, we take the middle lowest score of the two. So if you have one person that's 750, 780, 790, and then the other person is 650, 680, 690, then we're going for that other person that's in the 600. We're taking that score for the pricing and the qualification. And so sometimes you'll have an LO where they're looking at your profile, and they might pull one off and keep them on the title to get you into better pricing because that other person has a stronger credit score and they have enough income where we can debt ratio for underwriting.
Yeah. And I'm going to repeat that for our listeners in case it's the middle lowest score of the borrower. So really scores are important. And, I think one of the things that people can think about is there are some things they can do to help improve their score. So maybe, even if both people have lower scores, it may just in 12 months, you can do a lot of things. Can you share maybe some of the things you've had people do to help get their scores in position? And so maybe they couldn't do it now, but in 12 months, they get there because they've taken your advice and what you had them do.
Yes. And a lot of times where I see the lower credit scores, there might be something in collections or something in the derogatory section, or maybe there was a late pay in the past, or maybe the credit card usage is higher than that 35%. So I just look at the profile and I just kind of back into it. I'm like, okay, well, if there's anything in collections, go ahead and get that paid off and get that taken care of. You're going to see your score rise just from that. And then go ahead and try to pay down that credit card or pay it off and keep it below that, recommended 30% credit usage. And then sometimes I'll advise the borrower, go ahead and get a secured credit card, especially if they have like a lot in collections or in derogatory section, but they don't have any open accounts to really offset the negative that's on the credit report. So
yes, that is really good. Now, just one more thing on credit cards, because I know that you've probably ran into it, and I know all the other LOs have. You get approved for a home, you're working on the home, and I just want to make sure people understand this. And then someone says, oh, well, I need a new credit card, and I'm going to get a new car before I close. Because what's the one thing that always happens that lenders do right before they close the loan? They
refresh the credit.
Yes.
See if you went out and spent any money, if you bought any furniture. So wait until you sign the papers, you get closed, you're at the closing table. Then go ahead and get the furniture, get the new car, because it changes things. It changes that debt-to-income ratio.
Yes. And I think it's like a lot of people, they get approved, we've approved them, and you're just going through the process of closing, getting everything done. And so they're like, oh, okay, well, I've been approved and my score is this. And you can drop your score by doing a lot of the, if you do a handful of those things, you can drop your score by 30 points, and that could move you from one program to another. And then now maybe you don't qualify. So I think people forget about that. It's like, get the keys to your house, and then you can get the keys to other things. Okay. Thank you.
And I will say, it's easier to get that auto loan than to get a mortgage. So
yes.
I would get your house first where you're going to live, and then go buy the car. They're going to be able to get you finance.
Yes, that's good. So let's talk about, what do lenders need when it comes to income? So there's certain things people should have and all of that. So can you kind of walk us through all of those things?
And I'll kind of break it out into two. So you have your W-2 income, well, maybe three. You have your self-employed income, and then under that self-employed, I'm going to put 1099 income earners in that as well. So when you're W-2, you have to show, and even when you're self-employed, you have to show a 2-year history of employment. So underwriting, they're just looking for that consistency. You're in the same type of field, and so you have to have the history there. And then also, you're going to end up providing 2 recent pay stubs, and then like the past 2 years for W-2s. For self-employed, we're going to need the last 2 years business and personal federal tax returns. And so your income will be looked at based on what you filed on paper. That's what the mortgage underwriter is going to consider for your income. And then same with 1099, because they're taking out the taxes on their own and filing their taxes. Right. So we're going to get the tax returns from them as well. And again, like I said, underwriting, they're just looking for consistency. Say your W-2 income and you have a base pay and you have commission. They're going to look for that consistency over the past 2 years. You want to keep it the same. Try not to decline, because that doesn't look good for underwriting either. And just, like I said, they just want to see consistent income coming in.
Okay, that's good. So we've talked about what we need to see with income, the debt to income ratio, the DTI, as they say in the industry, and that. What's kind of what we're looking for, and how high can most lenders go? So what are we looking for in there?
The max is 50%.
Yes. Okay.
So want to stay below there. It can be stressful getting close to that 50%. I have some pre-approvals out there, and I tell them, if anything changes with the property taxes or the homeowner's insurance, I'm like, this might not go through. So I tell people, we have to be very mindful and don't spend anything. It goes back to that. Don't use any more credit. If anything, maybe pay them off and pay them down. So 50%, that's usually the max. And then you have something called FHA where you can sometimes go a little over
that. Yeah. And I want to amplify for our listeners out there. Chelsea's saying you can go to 50, but if you don't, like, if this is like a pre-approval, which she talked about, you don't really know where that home is going to be. So maybe you need to make sure you're kind of looking a little lower than what that home amount that you put into to make sure that you can stay there, because you don't want to find the home and then find out that you're at 52 or 53, because that changes a lot of things. So that leads me to my next question. Should you always buy a house at the level your lender says you can afford, or should you borrow less based on what your budget and what you feel comfortable with?
And I will say, I have people that go with what I tell them they can afford because they're looking at the house and they're getting out there and they're like, this is what I want. But once you get into that house and you're in there 3-4 months and you're paying that mortgage payment, you want to be somewhere where you're going to be comfortable, because you might have got this nice house that's almost $500,000 and the mortgage payment is almost like $35,000 or $4,000 and it's not comfortable. What I was going to say, you have to keep in mind with the mortgage, that payment could go up next year because your property taxes could increase and your homeowner's insurance could increase. Your financial institution is going to do an escrow analysis at the end of the year, whenever they do that. And that's when you're going to see a change in your payment. So I wouldn't personally go up to that max, because then your payment might keep getting higher and higher as your property taxes go up, because your value is going to go up. So I would stay in a comfortable area if possible, but I see them both. I see people who are conservative, they stay comfortable on the monthly payment. I see people that go for the dollar amount in the house, and that's where they want to live.
Yeah. And I know Chelsea, known her for a long time, and I know how she works with her clients, and I know she's always telling them, hey, you don't want to just spend the rest of your life in your house because you have no money to do nothing else, right? And so I know that that's kind of the advice that she's giving to you. And I guess the only reason why you might go to that is if you know that you're getting a promotion or more income coming in or something like that. Maybe someone is going back into the workforce. And so that's okay. But otherwise, you make a valid point, is nothing can change, and just property taxes and homeowners insurance, which over the last few years have been going up, and your payment goes up, and all of a sudden a little bit of that extra money you had. And it goes back to the first thing we talked about. You want to have a little money to put back for the emergency fund when the water heater goes out and those types of things. So that's very good advice. So I want to get to something that comes up a lot. Some people are concerned that they have to pay private mortgage insurance, or PMI. And, they say that's bad and you shouldn't do it. What say you, Chelsea Coleman, about PMI?
Well, PMI is not terrible. If you can afford it and you can put the 20% down, that's just going to save you on the monthly payment. But PMI, I mean, it's something else about PMI, and it goes back to the credit score. The stronger your credit score is, the better that PMI is going to look like. So I've seen it both ways, where I've had borrowers where the credit score wasn't as strong and they went ahead and bought the 20% down because the PMI was so high. But then I have borrowers where the credit score is 780 higher and the PMI might only be like $50 a month. And they're like, that's fine. We're fine with that. So I think it's kind of, what does that monthly PMI come back at? Once I run the numbers, I've run the credit, we see what the DTI is, and then I let them make that decision. If they can bring that 20%, I would bring it, because it's going to keep your overhead low, and it's going to allow for, if that payment goes up because property taxes or homeowners insurance, you don't have PMI on there.
Yeah, and that's good. And I'm going to relate a story that you told me about one of your borrowers a few years ago and how to make this decision. And I think this is important. And I know that you talked to your borrowers about it. You were saying you had a borrower that didn't want to pay the PMI, and they had found a house, but they're like, they didn't have the 20% to put down. They didn't want to pay the PMI. And you looked at what they were paying in rent and what they were going to pay in the house with the PMI, and that was less. And you're like, so I would buy the house because you're paying more rent, building no equity, and you're buying the house. And even though you're paying PMI, it's a lower payment and you're building equity. And the thing is, once the original loan gets less than 79%, the PMI goes away. It's not forever. And I think some people forget that. They think, well, I'm not going to pay PMI for the rest of the time. And that doesn't happen with that. So I think that's always a story that stuck with me as a real life example of, you really have to look at all things to say. Because why pay $1,800 a month in rent when you could get a house payment with PMI for $1,400? That's $400 extra a month you can save, right? Exactly. So we have to think about those things. So we talked a little bit about this, but what do you think are some important considerations for choosing a realtor for being your buying agent? So like, what are some important things if you were going out to find a realtor? What are characteristics that you think?
I think the first thing that comes to mind is finding someone that you can trust and you feel comfortable with. And that's the biggest thing, even from the mortgage side. When I have people that are shopping me, they might come with me just because they trust me. I'm giving them all the information. Like, you want someone that is on your team, because there are a lot of players that come together on getting you to the closing table. You have the realtor, you have the title company, and you have your mortgage LO. But the realtor is going to drive this transaction. They're going to get it under contract. So really, I think the biggest thing, like I said, finding someone you can trust and that you really can connect with, and where they can see your vision. Like, you tell them, like, hey, I want a 4-bedroom house. I need to have at least 2.5 baths. We need a fence. We have a dog. Like, someone that takes in your lifestyle, what you have going on, and get you into the house that you need and you want.
Yeah. And I think that's just the good advice is, and I think the other thing is, it's okay to talk to 2 or 3 realtors before you select one, because you, like you said, you want to have that good relationship, that you feel like you can trust them, and that you feel like that they're listening to you. And not everyone's going to have that connection with every realtor. And it doesn't mean the person that you don't choose isn't good. It's just maybe not the right fit for you.
Exactly.
Right?
Exactly. So finding someone you can talk to and you're comfortable.
Well, this has been a lot of great information. Is there anything else you think our audience needs to know or you would like to share?
Well, just stay strong, first-time home buyers. Save your money, get your credit together. Come see me when you're ready. I'm more than happy to help. And you can do it. Like, it can be discouraging sometimes, but just keep going strong and just put together a plan, and you'll become a homeowner.
Well, thank you, Chelsea, for joining me today. This has been really informative, and I know our listeners are going to have an instant connection with you because you come across with your genuine concern to help people put in homes. And I think that's, really important because, like you said, being a prospective homeowner for the first time can be scary, but you've really laid out the things to help people think about it. And I'm going to kind of close with the one thing that you said: have a plan, right? Have a plan, and that makes things go so much easier.
I agree. Thank you so much, Andy.
That's all for this episode of the Smarter Money Life podcast. Thank you for joining me. I hope you found our discussion helpful and inspiring. You can find more resources on the Smarter Money Life page at forumcu.com. Remember, making smart financial decisions is a journey, and every step you take brings you closer to your financial dream. Be sure to tune in next time for more tips and insights on managing your money. Until then, stay smart and financially savvy.